And these views, they vary dramatically from person to person.
So like different starting points.
Exactly. For instance, someone who grew up in severe poverty, they perceive risk and reward in ways the child of a wealthy banker just cannot fathom. It's a different world.
Right.
Or, consider someone who grew up during a period of really high inflation. They've experienced something tangible that someone who's only known stable prices just hasn't. And the stockbroker who lost everything in the Great Depression, their understanding is, well, it's incomparable to a tech worker who maybe flourished in the booming late 1990s. The list goes on and on. These unique experiences are truly endless.
So when we see people, say, on opposite sides of a major financial debate, like about recessions or investing strategies, it's not necessarily a battle of intellect. It's more like a clash of life stories.
Exactly. It's generally not about raw intelligence. What's truly striking and a bit mind-blowing is that our personal experiences with money might make up this tiny, tiny fraction, like 0.000000001% of what's happened in the world.
Wow, that's small.
Yeah, minuscule. But they account for something like 80% of how we think the world works.
90%, that's huge.
It is, and this raises a really important point about what you might call the unrecreatable power of fear and uncertainty.
The unrecreatable power of fear and uncertainty.
Okay.
That's a strong phrase. Can you give us an example?
Sure. Take John F. Kennedy. When he was running for president, a reporter asked him what he remembered about the Great Depression. And Kennedy basically said he had no firsthand knowledge. His family was incredibly wealthy. They actually had bigger houses, more servants, traveled more during that time.
So he didn't experience the hardship.
Not at all. He only learned about the Depression by, reading about it at Harvard. And this was actually a major point in the 1960 election against Hubert Humphrey, who had lived through it.
Right. Humphrey had that direct experience.
Exactly. And the challenge for all of us is that no amount of studying or open-mindedness can truly recreate the emotional weight of living through that kind of economic fear and uncertainty. You can read all about what it was like to lose everything, but you don't have the emotional scars, right? Spreadsheets can model how often stock markets decline historically.
Sure, you can see the numbers.
But they can't model that feeling of looking at your kids and wondering if you've made a mistake that's going to impact their lives.
Yeah, that's a different level entirely.
It is. As the investor Michael Batnick puts it, some lessons have to be experienced before they can be understood. And we are all, in different ways, kind of victims of that truth.
That makes so much sense when you put it like that. We've talked a lot about the anecdotal evidence and the logic behind it, but is there actual data? Has anyone formally studied how our personal histories impact our financial decisions?
Oh, absolutely. Back in 2006, two economists, Ulrich Mulmundier and Stefan Nagel, from the National Bureau of Economic Research, which is, a major nonprofit research institution, they dug through 50 years of the survey of consumer finances.
50 years. Wow. That's a lot of data. And what did they find? Was it as compelling as the stories?
I'd say so. Their findings were pretty profound. They discovered that people's investment decisions are strongly anchored to the experiences those investors had in their own generation, especially experiences early in their adult life.
Anchored. Okay, so those early years really stick.
They really do. For example, if you grew up when inflation was high, you tended to invest less in bonds later in life compared to people who experienced low inflation.
Right, because bonds got hammered.
Exactly. Conversely, if you grew up during a strong stock market, you tended to invest more in stocks later in life.
Makes intuitive sense.
And here's the crucial part. They concluded that individual investors' willingness to bear risk depends on personal history, not necessarily on intelligence or education or even financial sophistication.
So it really boils down to luck of the draw sometimes. When and where you were born.
That seems to be a huge factor, often just the dumb luck of when and where you were born.
So does that mean someone who lived through, say, 2008 or the dot-com bust might just inherently react differently to market downturns today, even if they're a super sophisticated investor now?
Well, that's what the research implies. It's like those early experiences get deeply ingrained.
But what about, education? Financial literacy? Surely, with enough knowledge, someone can overcome those early biases, right? Can you learn your way out of it?
You'd certainly hope so, and education helps, no doubt. But the research suggests these early experiences are incredibly persistent, maybe more than we think. And you see this play out in the real world. Like the Financial Times interviewed the famous bond manager Bill Gross back in 2019.
Oh, yeah, the Bond King.
Right. And he openly admitted he probably wouldn't be where he is today if he'd been born maybe a decade earlier or later. His career just happened to coincide almost perfectly with this generational collapse in interest rates.
Ah, so falling rates made bonds look amazing.
Exactly. It made bonds seem like wealth-generating machines to him. But, to his father's generation who'd lived through higher inflation, those same bonds might have seemed like wealth incinerators.
Wow. Same asset, totally different perception based purely on timing.
It's all about perspective shaped by experience, even for the most brilliant financial minds.
That dumb luck of birth year is really powerful. Can you give us some more, like, concrete examples of how different birth years would just radically shift someone's financial view?
Yeah, absolutely. So, say you were born in 1970.
Okay.
During your teens and 20s, those really formative years, the S&P 500 increased almost tenfold, even after adjusting for inflation.
Tenfold. That's incredible.
Right. That's an amazing foundational experience with stocks seeming like a sure thing. But if you were born, say, in 1990, the market was very, very different during your formative years. You saw the dot-com bust, then 2008. It leads to a completely different view on how the stock market works.
Totally different lesson learned.
Or think about inflation. If you were born in 1960s America, prices more than tripled during your teens and 20s. You might remember gas lines, stagflation.
And so as my parents told me.
Exactly. But if you were born in 1990, inflation has been consistently low your entire life.
Yeah.
It's probably never really crossed your mind as a major economic threat. It's just background noise.
And this goes beyond just birth year, right? You mentioned socioeconomic factors too.
Oh, absolutely. The scope broadens dramatically there. Take November 2009, deep in the Great Recession. America's nationwide unemployment was around 10%.
Which was high.
Very high. But it wasn't 10% for everyone. For African American males aged 16 to 19 without a high school diploma, that rate was nearly 49%.
49%. That's staggering.
It's almost unbelievable. Now, contrast that with, say, Caucasian females over 45 with a college degree. Their unemployment rate was just 4%.
Wow. Same country, same time, vastly different economic realities.
Precisely. And these differences extend globally, too. Think about World War II.
Okay.
Think about the impact on German and Japanese stock markets and economies. Entire regions bombed out. German farms, post-war, could only produce enough food for maybe 1,000 calories a day per person for a while.
Devastation.
Total devastation. Now, compare that to the U.S. economy during that same period. It was booming. The stock market more than doubled from 41 through 45.
Right. The war effort boosted the U.S. economy.
Exactly. So what this all tells us is, well, you shouldn't expect members of these vastly different groups to think the same way about money, or respond to financial information identically, or even trust the same sources of advice.
Because their fundamental view of money was formed in completely different worlds.
That's it. And when that's the case, a view that one group finds outrageous or crazy can make perfect sense to another.
Sometimes the numbers and theories, they only tell part of the story.
Yeah.
To really get these profound differences in perspective, you almost have to look at individual experiences, right?
You do.
That Foxconn sweatshop story you mentioned earlier, this seems like a perfect example of this. Tell us about that again.
Yeah, it really is. So the New York Times ran a piece, detailing the working conditions at Foxconn, the huge Taiwanese electronics manufacturer.
Right, making iPhones and other things.
Exactly. And American readers were, quite rightly, upset by the often atrocious conditions described. Long hours, low pay, tough environment.
Yeah, I remember the reaction.
But what's fascinating, truly fascinating, was a response in the comment section from the nephew of a Chinese worker there. He wrote in and he explained that his aunt had worked in what Americans call sweatshops. He acknowledged it all hard work, long hours, small wages, poor conditions. No argument there. But then he revealed something just eye-opening. Before working at Foxconn, his aunt had been a prostitute.
Oh, wow.
Yeah. And so, from her perspective, the factory job, despite all its challenges that seem horrific to us, was a profound improvement.
An improvement because
it meant her body wasn't being exploited anymore in the same way. It gave her a different kind of maybe dignity or control, even within those harsh factory conditions.
It completely reframes it, doesn't it? It really challenges our immediate sort of black and white thinking.
It absolutely does. It shows how relative poor conditions or improvement can be depending on your starting point and your alternatives.
That anecdote is incredibly powerful. It really hammers home the point that every financial decision a person makes, whether it seems logical to us or not, actually makes sense to them in that moment.
Exactly. It checks the boxes they need to check based on their reality.
They tell themselves a story about what they're doing and why, and that story is shaped by their own unique experiences. They might be misinformed, sure, or have incomplete information, maybe be bad at math or misjudge the consequences.
All possible.
But in their mind, in that moment, it works. It makes sense.
Which brings up an important question. If this is true, how do we explain something that seems so clearly crazy to many of us, like buying lottery tickets?
Ah, yeah, the lottery. Good example.
The stats are pretty wild. Americans spend more on lottery tickets than on movies, video games, music, sporting events, and books combined.
Combined. That's unbelievable.
And who buys them? It's primarily low-income households. They spend, on average, about $412 a year. That's 4 times the amount spent by the highest income groups.
$400.
Yeah.
And wasn't there a stat about emergency funds?
Yes. Shockingly, 40% of Americans can't come up with $400 in an emergency.
So the people buying $400 in lottery tickets are often the same people who don't have that tiny safety net. That does seem crazy on the surface.
It really does.
When I first looked at those lottery stats, I admit I found it baffling. It just didn't compute with conventional financial wisdom,
Of course.
But then, if you really try, if you strain a little to step into that mindset, the why starts to maybe emerge, doesn't it?
How so?
Well, you can almost imagine their reasoning. It might go something like this. Look, we live paycheck to paycheck. Saving, that seems completely out of reach. Our prospects for really getting ahead or even putting our kids through college without just crippling debt, they feel slim.
A feeling of being stuck.
Yeah. And much of the good stuff that you people, people who read finance books, either have now or have a pretty good chance of getting. Well, we don't. We just don't see a path.
Okay.
So buying a lottery ticket, that's the only time in our lives we can hold a tangible dream of getting the good stuff that you already have and maybe take for granted.
Yeah.
We are paying for a dream.
Paying for a dream.
And you may not understand that because you are already living a dream, or at least have a realistic shot at it. That's why we buy more tickets than you do.
Now look, you don't have to agree with that reasoning, right? Buying lottery tickets when you're broke is still, generally speaking, a bad financial move.
Objectively, yes.
But understanding the why, understanding that narrative they're telling themselves, it bridges the gap. It makes the behavior comprehensible, even if not advisable.
Right. It shifts from crazy to understandable, given their perspective.
Exactly. And the truth is, very few people make major financial decisions purely with a spreadsheet. They make them at the dinner table or maybe in a company meeting where personal history, their unique view of the world, ego, pride, marketing, odd incentives, it's all scrambled together.
Scrambled together into a narrative that works for them.
Precisely.
This leads us to another really crucial point, doesn't it? Something else that helps explain why money decisions are so difficult and why there's so much perceived misbehavior out there.
Yes, and it's about how new all of this is.
New, but money's ancient, right? King Aliada's Lydia, 600 BC.
Money itself, yes, ancient. Coins, currency, that's been around for millennia. But the personal responsibility for managing it, for saving and investing for your own future, that's actually a very, very recent development in human history.
Okay, tell me more about that. How new are we talking?
Well, what's fascinating here is just how new some of these core concepts really are. Take retirement, for example.
Okay, retirement.
Yeah.
Seems pretty standard now.
Now, yes, but before World War II, most Americans simply worked until they died. That was the expectation, and it was the reality.
No golden years relaxing.
Not for most. Social Security was established, sure, but its initial benefits back in 1940 were tiny. Ida Mae Fuller's first check, $22.54.
$22.
Yeah. And it wasn't until the 1980s that the average Social Security check, even adjusted for inflation, consistently exceeded $1,000 a month. So the idea that everyone should save and invest their own money to ensure a dignified retirement, that only really took hold in the 1980s.
The 80s? That's surprisingly recent.
It really is. And to reiterate how new this is, the 401k, right?
Yeah.
The backbone of American retirement savings now. It didn't even exist until 1978.
Wow.
And the Roth IRA, born in 1998, if it were a person, it would barely be old enough to drink legally in the U.S.
That's incredible. So these cornerstones of modern personal finance are younger than many of the people using them.
Absolutely. And the same pattern holds for college education.
How so?
Well, the share of Americans over 25 with a bachelor's degree went from less than 1 in 20 back in 1940
Tiny percentage.
to about 1 in 4 by 2015. And during that same time, average tuition rose more than fourfold adjusted for inflation.
So more people going and costing way more very quickly.
Exactly. Something that big and important hitting society that fast. It helps explain why so many people have made maybe poor decisions with student loans over the last 20 years. There just aren't decades and decades of accumulated experience for society to learn from.
We're essentially winging it.
We're winging it. And modern investment vehicles, also very new. Broad market index funds, the easy way to invest across tons of companies. They're less than 50 years old.
Less than 50.
Hedge funds, they really only took off in the last 25 years or so. Even widespread consumer debt, mortgages, credit cards, car loans, didn't truly explode until after World War II, partly spurred by things like the GI Bill.
It's kind of like that analogy. Dogs were domesticated, Brett, 10,000 years ago, and they still retain some behaviors from their wild ancestors.
Right.
And here we are with maybe only 20 to 50 years of real, widespread experience in this modern financial system.
Yeah, 50 years is generous for some of this stuff.
And we expect ourselves and each other to be perfectly acclimated, to make all the right decisions all the time. It's almost comical when you frame it that way.
It really is. And for a topic like money, which is so heavily influenced by emotion versus pure fact, this newness, it's a major problem and helps explain why we don't always do what we're quote-unquote supposed to with money.
Okay, so let's try and wrap this up. To summarize our deep dive today, we all do things with money that might seem crazy to others, but it's often because we're all relatively new to this complex game, and we're operating from our own unique set of experiences that fundamentally shapes our perspective.
That's the core of it.
So no one is truly crazy. We're all just making decisions that make sense to us in that specific moment, given the story we've built from our own lives.
Right. And maybe a final thought for you to consider as you go about your week. Think about someone whose financial decisions you might judge, maybe someone you see as irrational.
Okay.
Instead of just dismissing them outright, take a moment, ask yourself, what personal experiences might have shaped their unique story? What could make those choices seem perfectly logical to them?
Flipping the perspective.
Exactly. And then maybe ask, what does that contemplation tell you about the assumptions you might be making about money and about how the world works?
To my reputation.
Wow. That sounds, I don't know, like a coping mechanism, like trying to rationalize away the loss.
It's easy to see it that way. Maybe the worst possible takeaway, right?
Yeah.
A way to feel okay about something that really isn't okay. Suggesting reputation doesn't matter after yours is, frankly, ruined by your own actions.
Yeah, because let's be real, reputation is valuable, massively valuable.
Absolutely.
And so is freedom, independence, your family, your friends. Being loved by the people you want to love you, happiness itself. These things they're priceless.
Exactly. They are the things that truly matter. And your best shot, maybe your only shot, at keeping those invaluable things safe
is knowing when to stop taking risks that could destroy them.
Knowing when you have enough. It's the ultimate shield for what's truly important.
So understanding enough isn't just about money on a spreadsheet. It's about protecting your whole life, really, the things that actually make it worth living. Well said. It guards your freedom, your relationships, your peace of mind.
And the good news, maybe, the best tool for building that sense of enough. It doesn't require some complicated financial strategy or taking huge risks.
Not at all. It's simpler. It's more about perspective, about recognizing what you value and realizing that true wealth isn't just accumulation. It's also about knowing what you have and choosing not to risk it for something you don't truly need.
So maybe the final thought for everyone listening is, what does enough actually look like for you? What are those invaluable things you aren't willing to put at risk? Welcome to the Deep Dive. Today, we're taking a look at a really fascinating stack of sources you sent over. Articles, research papers, even some personal notes. And they're all grappling with this question, that we all think about. What really drives success and failure?
Yeah.
In our finances, in our lives.
Yeah, and we love those simple stories, don't
Oh, absolutely. The lone genius, the innovator who just worked tirelessly, the bootstrap story.
Right, and then failure is just, they made bad choices or they were lazy.
Exactly. But our mission today really is to unpack the incredible complexity behind all that.
It's true. We really look for those clear cause and effect lines, those tidy narratives. Yet, as these sources really show, every outcome in life is guided by forces other than individual effort. So this deep dive is all about those kind of hidden roles of luck and risk. They're so intertwined.
Totally intertwined. And actually, to kick us off, there's this great idea from NYU professor Scott Galloway, perfect for this.
Oh.
He says, nothing is as good or as bad as it seems. And you can think of luck and risk as like siblings.
Siblings. I like that.
Yeah, two sides of the same coin. Really, you can't actually separate them.
That's a powerful way to put it. These siblings, luck and risk, they're forces mostly outside our control, aren't they?
Mm-hmm.
But they just heavily influence where we end up. The world, as these sources suggest, it's just way too complex to think that 100% of what we do dictates 100% of what happens.
Right.
Sometimes those outside factors, the things we don't choose or even see coming, they can matter way more than all the careful planning we do.
So if they're that powerful, why are we, as humans so resistant to seeing it? Is it just needing control or?
I think it's a mix, definitely partly control, but also these forces, randomness, pure chance.
Mm-hmm.
They're just so hard to measure.
Yeah.
So hard to really accept. It's easier to just gloss over them. We prefer to think we're fully in the driver's seat, that our actions alone shape our destiny. It just feels better, more empowering, even if it's not the whole story.
Okay. Let's dig into this with a case study then. It really brings this stuff to life.
Oh.
We're talking about, one of the most successful people ever, Bill Gates. Now, obviously, brilliant guy, driven, visionary, all that.
Sure, no doubt.
But let's look at this 1 in a million head start he had.
Okay. This starts back in 1968. Gates is 13, attending Lakeside School near Seattle.
Right.
And the really extraordinary thing, as the sources point out, is that Lakeside was one of the only high schoolers in the entire world that had a computer back then. It almost sounds made up today.
It really does.
Yeah.
And how did they even get it? It wasn't like some big corporate donation or something.
No, not at all. That's the amazing part. It was a math and science teacher, Bill Dougal. He'd been a WWII Navy pilot, and he just had this foresight. He believed kids needed real-world experience, especially with computers. So 1968, he goes to the Lakeside School Mothers Club.
The Mothers Club, like bake sales and stuff.
Exactly, the ones who raised money from rummage sales. He asks them for just $3,000.
$3,000.
To lease a teletype Model 30 computer.
That's incredible.
And it wasn't just any old machine. It was hooked up to a General Electric mainframe for time-sharing.
Which was brand new tech then, right?
Super new.
Okay.
Gates himself said time-sharing was only invented in '65. So Dougal was incredibly forward-looking.
So forward-looking.
And get this. Most university graduate schools back then didn't have access to a computer as advanced as what Bill Gates had in 8th grade.
That's just a staggering advantage. So what did he do with it? Just mess around?
Oh, no, he devoured it. He met Paul Allen there, and they basically lived in that computer room. Nights, weekends, learning everything. Allen even remembered Gates showing him a Fortune magazine, asking, "What do you think it's like to run a Fortune 500 company?"
Already thinking big.
That ambition, starting in that unique environment, that led to Microsoft. Now worth, over $1 trillion?
Incredible. So let's try and quantify that luck. Like you said, 1968. How many high school age kids were there?
Okay, globally, roughly 303 million.
300 million. Wow.
In the U.S., about 18 million. Washington State, maybe 270,000. Seattle area, a bit over 100,000.
And Lakeside.
Just 300 students.
So 303 million down to 300.
Yep. That puts Gates at roughly 1 in a million high schoolers worldwide who went to a school that had both the money and the vision to get that computer.
1 in a million.
And Gates knows it. He told Lakeside's graduating class in 2005, straight up, if there had been no Lakeside, there would have been no Microsoft.
Huh.
So yes, staggering intelligence, hard work, vision, absolutely. But he also acknowledges he had that 1 in a million head start.
It really makes you wonder, doesn't it? If someone like Gates, admits this huge slice of luck,
Right.
What about the flip side? What happens when those same random forces work against someone just as talented? And that brings us to Kent Evans.
Ken Evans, Bill Gates' best friend back in 8th grade.
Yeah.
And according to Gates himself, Kent was the best student in the class.
Wow.
Just as good with computers as Gates and Paul Allen. They actually built a program together to sort out the school's really complex class scheduling, and apparently it worked perfectly.
It's kind of striking hearing Gates talk about him, even remembering his phone number after all those years.
Yeah, 525-7851. He said he called him countless times.
And apparently, unlike Allen maybe, Kent had that same business drive as Gates, that endless ambition.
Totally. Gates remembered Ken carrying this big briefcase like a lawyer's.
In 8th grade.
Yeah, and always scheming, as Gates put it, about the future. Should we be CEOs? What kind of impact could we have? Generals, ambassadors, whatever it was, they figured they'd do it together.
They didn't.
No. Tragically, Kent Evans died, a mountaineering accident, before he even graduated high school.
Oh, man.
Based on everything Gates said, he could easily have been a founding partner of Microsoft right alongside Gates and Allen. Same skills, same drive.
And the odds there, they're just as stark, aren't they? Mountaineering deaths.
Yeah, incredibly rare, especially for a high schooler. Only about 3 dozen total mountaineering deaths in the U.S. each year.
So the odds of that happening to him specifically?
Roughly 1 in a million. Same odds, different direction.
Wow. 1 in a million luck for Gates, 1 in a million risk for Evans.
Exactly. That's the core lesson here, I think, from these sources. Gates gets the lucky break, Evans gets the unlucky one.
Right.
Their paths were so aligned, then just diverged completely. It perfectly shows how outcomes can be guided by forces totally outside our effort.
And they're so similar, those odds. You really can't believe in Gates's luck without also respecting Evans's risk.
You absolutely have to. They're two sides of that same coin, like you said earlier.
Which brings us back to how we process all this. We really do prefer to think success is all skill and hard work.
Oh, definitely.
And failure. Just bad decisions or laziness. It's cleaner,